Okay. Backing up to some of the lecture, getting out of the math of the cost approach for just a second. Let's finish up the lecture part of the cost approach. Determining reproduction or replacement costs can be done in one of three ways. The way you would do it in math, and the only math way you would have be the way we just did, which is the square foot method. Okay? You'll never see this unit in place or quantity survey as part of a math question, but you might be asked about it as a theory question. Okay? The idea here is that the square foot method is the most commonly used one because it's the easiest one. It's pretty easy to say 12,000 square feet at $50 a square foot. These methods are much more accurate, but they're also much more tedious. And the further you go down that list, the more tedious they get. So just to give you an idea for comparison purposes, a unit in place method would be pricing things by the framing would cost you $25,000, the roof would cost you $18,000, the plumbing would cost you $50,000, the concrete would cost you $30,000, and you add all those together and there's your replacement cost. You see how that would be more accurate, right? But it's also much more tedious. We can get a lot more tedious than that. The quantity survey method literally breaks it down to how many nails you need. 3,482 pounds of number 10 nails. 6,484 feet of number 2 copper pipe. That is the quantity survey method. It breaks it down to the smallest material. 23,450 labor hours. It breaks down your labor, your materials, everything, bit by bit, piece by piece. By far the most accurate way to value a building using the replacement cost, but also not practical for the vast majority of buildings. Really, the only time you would see this is the military. They're the only ones that keep records that are this good. And they can do the quantity survey method because they keep the records, but pretty much anything else, you'd never see it. By far most common, square foot, for obvious reasons. Just so much easier. All right, is everybody okay on that? Now, your book gives you different types of depreciation. Like I said, from a math perspective, as long as you can deal with that age-life method, the straight line method of depreciation, you're going to be fine from a math perspective. But you do need to know the different types of depreciation from a theory perspective. Okay. First of all, depreciation comes in both curable and incurable forms. Sounds like you have a disease, right? Well, depreciation is sort of a disease for a building, and it can be either curable or incurable depending on the type it is. And just for reference points, this is on page 406 of your textbook, 405 and 406. The first type of depreciation that your textbook gives you is something called physical deterioration. Physical deterioration is exactly what it sounds like. The building needs work. It needs repair. Things have broken down. Maybe it's developed a leak. Maybe it needs painting. Maybe it needs replacement of windows. Maybe it needs a new roof. That's all physical deterioration. Would you agree with that? And physical deterioration can be either curable or incurable. Now, you got to redefine what curable and incurable means for you. There's no such thing when it comes to a building as truly incurable. In other words, everything can be fixed. The question is, how much does it cost, right? So the way we define curable and incurable when we're talking about depreciation is it worth it to fix it? Is it economically feasible, or are you investing more in fixing it than the property's worth in the first place? Does everybody follow that? So the definition of a curable physical deterioration is one that it's worth the investment. Painting your house, that's physical deterioration if it needs painting. Well, the paint might cost $4,000, but your house is worth $200,000. Obviously, it makes sense to paint it. But you go find one of these old houses out in the country, and the roof is collapsing, and the siding needs replacing, and If it were in perfect shape, it'd be worth $150,000 and it needs $180,000 worth of work. That is incurable physical. Sure, if you wanted to, you could, but there's no economic sense in it. So does everybody see the difference between the curable and incurable? That's also true for this thing called functional obsolescence. That can be either curable or incurable as well. Yep.
For these other questions, will they use these words to like trip you up? Like, will they say like, you know, functional obsolescence is this, or will they give it to you like in a real world situation? Like
They'd ask you, you know, like they might say something. They're giving you functional obsolescence, for example. So functional obsolescence is defined as being outdated. You know, it might still work. It might not be broken, but it doesn't work for today's world. You know, like example, a 5-bedroom house with 1 bath. That's functionally obsolete. You know, because it's not what a current buyer would want. So what they might say in the test question there would be, you know, Travis is listing a property at 123 Main Street that has 5 bedrooms and 1 bathroom. This would be an example of, and one of the answer choices might be, a functional obsolescence.
I guess we have to know the definitions of these words.
You do have to know the definitions of these words. Absolutely. Absolutely. So functional obsolescence is a situation where the property is outdated. It needs some upfit. It needs some changes. Things aren't broken. That's physical deterioration. Brass water faucets in a bathroom and brass anything anymore, honestly. You know, you go into a house and all the light fixtures are shiny brass. All the door handles are shiny brass. And the bathrooms have it. I mean, it looks like, you know, the scene from Coming to America where he holds out the combs and toothbrushes, you know. That's what the bathroom looks like. That is functionally obsolete. According to the vast majority of today's buyers, you know. And so that, but the question is it a curable functional obsolescence or is it an incurable one? That's an example of a very curable functional obsolescence. Some people try to confuse functional obsolescence with physical deterioration. There's nothing wrong with those brass fixtures. They function fine, but they're not the expectation of the overall buying public. Does that make sense? And so that makes it a functional obsolescence, which lessens the value of the property. That's why it's depreciation. And so replacing those would be considered a very, you know, simple thing to do versus the value of the property. So that's a curable functional obsolescence. Whereas my example with 5 bedrooms and 1 bath, that might very well be an incurable functional obsolescence because the cost of trying to add a bathroom where one has not existed before might be cost prohibitive, right? So that's the difference between curable and incurable as well on the obsolescence front. An office building that was built in the 40s with no air conditioning and the ceilings are too low to have air conditioning ductwork installed now. That is an incurable functional obsolescence because you can't have office space now with no air conditioning. No, I'm not going in there. I don't care what they got in there. I'm not sitting there all day without air conditioning. And if the ceilings are so low that you can't retrofit it with air conditioning, it's incurable. It doesn't mean the building's worthless. It just means it's not going to have nearly the value of a property that, say, had that same issue but had tall enough ceilings where you could come in and put in air conditioning, because then that would be a curable functional obsolescence for that other building. You see the difference between the two? The last one only comes in a incurable variety. And the reason this one is incurable is because it's not in our property. It's somewhere else. What we mean by that is something outside of our property is negatively impacting the value of our property. If someone puts a landfill next door to our property, can we fix that? I can't do anything about it because I don't own that property. As long as they're not breaking the law. Does it affect the value of my property in a negative manner? Absolutely. That's called an economic obsolescence, and it's always incurable. And the reason is because I can't control it. That doesn't really have anything to do with the functional value, just I can't control it. It's outside of my control as a property. So we've talked about the methods of calculating depreciation. I hope everybody's okay on that. If you're not, I'm going to put these videos up on YouTube. Go back and watch it again, if you have questions about that. Everybody good on the cost approach before we move on here? Is everybody good on the cost approach? So we've done 2 of the 3 approaches to value so far. We're 2/3 of the way done with methods of value in property. We've learned to value what kinds of property? Residential, vacant land, with the sales comparison approach, and special use with the cost approach. So what kinds of property are we left with? Income properties, income producing properties. And it should come as no surprise that the way you value income producing properties is with something called the income capitalization approach. Here's the way to think of the income capitalization approach. If I'm buying the property for the purpose of producing income for myself, then the only value the property has to me is the ability to do what? Produce income. And so what we've done in the income capitalization approach is we've made it a math equation. We've said this much money out is this much value. This much of a return on my investment is this much value. Does everybody follow that? So what the income capitalization approach does is it compares the expected future income with some return on investment and spits out a value for that property. It's simply a math equation. And for some of you, you might be glad to see it again. It's been a while. The math equation looks that. We've seen that before, right? We call this guy Earth. Income, but a particular type of income. Remember when we did property management and we took our gross potential income, which was the most amount we could make, and we subtracted out all of our operating expenses from it? What was that income called after we subtracted out our vacancy losses and then subtracted out our operating expenses? What was that income called? Net what? Net operating income. So when we say ERV, the income we mean is net operating income. Remind me again what I told you was not part ever of net operating income. What numbers do you not take into account when you're calculating net operating income? Mortgage payment, debt service, principal, and interest, right? You don't take that into account. Net operating income is before that money comes out. So the first thing we need to know to calculate the value of an income producing property is its net operating income. Of course, the V stands for value. That's what we're trying to calculate. R always stands for rate. But this is a different kind of rate. This is something called a capitalization rate. A capitalization rate. So, what is the cap rate? Best way to think of it is, it's the rate at which we make our money back. It's one way to look at it, right? How fast I'm going to make my money back. Or another way to put it, how much of my investment am I getting back? How much do I have to invest to get this amount of income? It's another way to think of a capitalization rate. okay, if you want to kind of turn it on its head. How much money do I have to invest in order to produce this amount of income? Is everybody following me with that? I want you to do something for me real quickly. Let's say we have a property with a value of $1 million. And a capitalization rate of 6%. Tell me what the net operating income of that property is. $60,000, right? They're beside each other. So we would have a net operating income of $60,000, right? Tell me what the net operating income would be at 11%. If you had to pick which income you'd rather have, which one would you rather have?
110.
I'd rather have 110, right? Especially if my investment, the value of the property, stayed the same. Wouldn't I rather invest, if I'm investing $1 million, wouldn't I rather make 110 than 60? I do that so you can answer your own question, because somebody's going to ask me this question. Well, do you want your cap rate to be higher or lower? Higher. Right? So if you're an investor and you say, I want a 10% cap rate, that means you want a 10% or higher. Not 10% or lower, you want it 10% or higher. Does everybody follow that? It's just a visual representation of where investors want this stuff to be. So when a client that's a commercial client is shopping for property, especially an investment owner, their ownership becomes a simple math equation. A lot of times they will come to you and they'll say something like this: I'll buy any hotel you can find me with a 15 cap rate. You know what he just told me? 15% cap rate, right? I'll buy any hotel you can find me with a 15% cap rate. Well, here's the thing. Can't any hotel have a 15% cap rate?
Sure. Well, sure. If the value is
Because aren't we the buyer? Can't we change this piece of it?
But what's offered?
Oh, what's offered. That's how we determine what we offer on a commercial property. We don't look at comps. We don't go out and say, well, a fireplace is worth this and granite countertops are worth that. We simply say 15% or better. And then we go look at a hotel and they tell us, well, we have a net operating income. Why would they tell us that? Because they're trying to sell the damn thing. And they know you want to see their books. Wouldn't you, if you were buying a hotel, wouldn't you want to see their books? Absolutely. You see their books, catch what you can get from their books. Their net operating income. My client just told me to buy any hotel with a 15% cap rate. I found a hotel that has a net operating income of $400,000. Haven't I found what my client would be willing to pay for that hotel? 2.6 million? 2.67 million? Does that make sense how that works? That's how investors buy commercial real estate. I mean, it's a simplified version, I get that, but the basic concept is that the investor decides what this number is going to be, and all we have to do now is find, through looking at their books, what the net operating income is of a particular property, and that tells us what the investor will be willing to pay for that. So what we're saying here is if he gets it for 2.667 million, or what? Or less, then he's going to have a cap rate of 15% or more. Does that make sense? You see how it's just a math equation. It ties value to return on investment. That's what the income approach is about. It's about a comparison between value and future income.
And they all have equal, like this. He offers lower.
If he offers lower, then he's above a 15% cap rate and he's happy. So what he would know, what the math equation tells him is that I can't pay more than 2.667 million or I'm not gonna have my 15% return.
So you change that,
That changes.
to equal that.
That's exactly right, because this number doesn't change.
Right.
That's in their books, right? So the numbers that we're playing with are the ones down here on the bottom. And he's already dictated this number. Well, if this one's in the books and this one's been dictated and this one's locked in. Of course, I'm sure he would take it less.
Unless they're willing to just take a loss.
If they, if they'll take 2.5, he'll be happy with that, because that's even better than a 15% cap rate. Does everybody follow that? I mean, heck, here's the thing, folks. When an investor comes to you like that, they shop so differently. If they come to you and they say, I'll take the cap rate of 15 on any hotel you can find me, he hopes I find him one that costs him $20 million. Because if I find him one that costs him $20 million, how much is the income going to be up here? It's still 15% of that $20 million. It's a lot of money.
Yeah, because if you do the math, you get the lower number for the net operating income, but that's just because you did the calculation. Because the actual
Right, the net operating income is going to be much more on a property.
That's what they're saying.
Exactly. Is everybody following this whole concept here? How this works? So, how do you do the math of these things? Obviously, the T-bar is easy. You know, if they just gave you cap rate and they gave you value, you could calculate net operating income, no problem. Just boom, there it is. It ain't gonna be that easy. What they're gonna give you is gross income, expenses, debt service payments. Try to figure out, can you get to a net operating income? Can you calculate a net operating income? Look on the top of page, I'm sorry, wrong page, 409. On the top of page 409, it gives you a good example of what an income capitalization problem looks like. We've got looks like rental properties, and if they're at 100% capacity, they can collect $60,000 in annual rent. Does everybody see that? They've got vending machines that produce other income of $600, so their gross potential income, remember those labels? They're important. Their gross potential income is $60,600. Minus their vacancy and collection losses, $2,400. So their effective gross income is $58,176. Now, we subtract all their expenses because we want to get the net operating income. Taxes, insurance, heat, maintenance, utilities, repairs, decorating, replacement of equipment, legal and accounting, advertising, management fee. In total, they have expenses, operating expenses, of $27,300. When you subtract that from their net effective gross income, you get their net operating income of $30,876. That's what goes to the top of the T-bar. That $30,876. They've given you a capitalization rate of 10%, so that says that the value for that property, based on that capitalization rate, is $308,760. Does everybody see that? In other words, and some investor is willing to invest $308,000 in that to produce $30,000 worth of income.
Quick question.
Go for it.
What is the capitalization rate? How does one?
It's a really good question. We are getting there, absolutely. And it's a good thing you asked, because they're not going to always give it to you, okay? So, the T-bar is a wondrous thing, because not only will it help us calculate the value, it'll help us calculate capitalization rates too. Real estate, I said we weren't gonna compare, I lied. You always compare. Everything's a measuring contest. You compare everything. And so what we do when we go out to value a property like this, now, it's one thing to figure out what an investor would be willing to pay, because they just dictate the capitalization rate. But when we're actually valuing a property, when an appraiser goes out to value a property, they need this number. They can look up and find the net operating income through researching the books, right? But they need this number to come up with a value. The art of doing an appraisal on an income property is coming up with this number, coming up with the capitalization rate. So here's how we come up with the capitalization rate. I've been sent out as an appraiser to value this car wash. I'm going to find 3, 4, 5 other car washes that have been sold, and here's the thing, I don't care where, anywhere in the country recently. Because commercial real estate is not local in nature the way residential real estate is. I'm going to find 3 or 4 or 5 commercial car washes that have been sold anywhere in the country. Am I going all the wrong time?
No, I just gotta run, sorry.
Well, that's fine. I just want to make sure it wasn't me. Because what I can find based on those sales, what did they pay for it, which is value, and what's the net operating income of those properties. Well, if I found 3 or 4 or 5 sales where I know what they paid for it, and I know the net operating income of those properties, what can I calculate out? I can calculate out my cap rate. And I can come up with an average cap rate for car washes. Does that make sense? This is what investors nationally are willing to accept as a cap rate for car washes currently. So if I'm valuing a car wash, I'd want to know, what is the cap rate that investors expect on car washes right now? Once I've figured that out, I can go look at the books of the car wash I'm trying to value, figure their net operating income, and then I got the value of this car wash before me.
When you're looking at all the other car washes, where are you finding their NOI?
You go to their books.
So you, and that's like,
Allow.
yeah, like you're gonna say, hey, I'm a,
So you go to the broker that sold the property. You
okay.
go to the broker that sold the property and you say, hey, what was the net operating income on your that
It's
sale?
okay for them to just discuss.
Absolutely, because the system works because of that. Commercial property owners understand that to value their own properties and to refinance their own properties, if you couldn't get that information, nobody would ever be able to do it.
Because there's like no rules on the commercial side.
There really aren't, absolutely.
It
Absolutely.
just seems confidential.
Well, it is if your client tells you not to disclose it. You wouldn't, as a broker, disclose it without asking your client first.
Okay.
But probably but remember, here's the thing, your valuation is based on this too, so you probably want to help yourself out. You know, you're gonna have to refinance at some point. So your broker comes to you and says, hey, you know, this appraiser just called me from North Carolina and he's trying to value a car wash down there and he wants to know if we can disclose the net operating income when you bought the property. Most owners of those kinds of properties are gonna say, that's fine. Will there be some that won't? Absolutely. That means the appraiser's job just got harder. They gotta find another car wash
So what you just said, but you have to have the NOI at the time the sale was
at
made.
the time the sale was
It's
made.
not the current, right?
At the time the sale was made, because that's when the cap rate was established for that transaction. Does that make sense?
Yeah.
Just commercial.
Just commercial,
Okay.
just commercial.
Work for a college place, apartments rented out, a house rented out.
Well, hold that thought.
Because technically they have a net operating income.
Absolutely.
They're paying $4 a month.
Absolutely, and there is, and we actually do, it's good you bring that up. If it looks residential, but the whole purpose of it is to generate income, we still use a form of the income capitalization approach to that, but it's a simplified form. We don't use cap rates, and it's called a gross rent multiplier. But it's a simplified form of
There
this.
it is.
Yeah, it's the next thing. This is a good question, a really
So
good question.
advanced.
Yeah, absolutely, you're just ahead of the curve, you know? What can you say? But so does everybody understand how this process is gonna work? So when you get a math question about this, They're gonna be testing you on a couple things. Can you calculate net operating income? Do you know what things are part of net operating income and what things are not part? What's not part of it? Debt service, the mortgage payment. What is net operating income minus the debt service? What do we call that? That's cash flow. That's cash flow. You can have two properties that have the same net operating income and they have very different cash flows. One has a mortgage, one doesn't. Does that make sense? And that's the reason we don't account for the mortgage in it, because if we accounted for them, you see how important net operating income is to value here, since it's a math equation? If we had two identical commercial properties side by side with the same income being generated, and one had a mortgage and one didn't, if we factored the mortgage into net operating income, they'd actually be valued at different amounts, and that makes no sense. Logically, that just doesn't even register, right? And so that's why the mortgage, the debt service, is not part of that calculation. So the first thing they're going to be testing you on with these kinds of questions is, can you get to a net operating income? That's number one. Number two is, can you figure out a cap rate based on some other recent sales? And so what you're looking for in those other recent sales are their net operating income and their sales price. Come up with a cap rate. Net operating income, sales price, come up with a cap rate. Net operating income, sales price, come up with a cap rate. I've got three cap rates, I average them together. This is the average capitalization rate for this type of sale.
So you can't average this.
You can just average for the capitalization rate to come up with the capitalization rate. What you don't average is when you talk about the sales comparison approach and you come up with those 3-4 values down there, you don't average those numbers together. That's a range of value. But when it's something like a capitalization rate, yes, absolutely, you come up with an average one. Is everybody okay on that? All right.
I have a quick,
No, go for
I
it.
just remember a question like this, and I think I brought it before, and I can't remember the answer, but the capital improvements are not in the NOI.
Correct.
So, because I can remember having a question that was like, or are we gonna come up to that? Have we?
We're gonna get there with taxation when we start talking about capital improvement,
that's
but I can talk about it now, that's fine.
Good.
So there are things, these things exist called capital improvements. A capital improvement is different than a repair. A repair is fixing something. A capital improvement is replacing that thing. The capital improvements also aren't part of the net operating income. The idea here is that a capital improvement actually raises the value of the property, so you don't count that as an operating expense, okay? But I don't think you'll ever have an income capitalization question that also combines the idea of capital
I just
improvements.
remember when it was like a ton of these things were listed, and one of them was like, I replaced the roof.
Replace the roof.
And-
That would be for capital
and
gains
you
taxes,
just- and
right?
you
You just
ignored
ignored it, right?
But not to mention, if you go to a place, all your fixtures, more likely than not, the houses and prices have changed.
Well, right, and plus that's not an operating expense. That was an optional thing you chose to do. The idea of operating expenses is these aren't optional. This is what it takes to operate the property. And those are the things we want to deduct from the income to come up with that net operating income. Right? So, pull out your calculation sheet the one we started with, and on page 2, number 4 is a income capitalization problem.